Hello traders and welcome to another video review. Today is Tuesday, January 11th, 2022. Let's start with the Forex calendar. Retail sales from Australia has beat the expectations of 3.5% with the actual reading of 7.3%, which is better than the last month reading of 4.9%. So we will definitely take a look at the Australian dollar later on. The trade balance is shrinking to $9.42 billion. During the London session, there isn't much of important data scheduled for release. However, during the New York session, we got the FOMC speeches. Member Loretta Messner will give a speech, Estelle George will give a speech, and then at 4 o'clock, Federal Reserve Chairman Jerome Powell will give a speech as well. So no data from the US, but we got some speeches that might influence, impact the markets, and we might expect some higher volatility during the late hours today. So that's about it. That's everything we got on Tuesday. Let's start with the Australian dollar. The Australian dollar on a daily time frame chart has perfectly been capped at the level of 50% of the Fibonacci retracement of the last wave down. As you can see, we got this level at 7,279 pips, and this is the C wave of our ABC pattern. This is a free wave pattern, which means it is a corrective pattern. It's a little bit under the 100% of the market geometry levels. Wave A equal to 100% of the wave C, or wave C is equal to 100% of wave A. However, this is still kind of an additional measurement. Wave B was I'm just looking for the measurement of the decline, 1.96, and the current decline is 2.7. So it's already bigger than the wave B. So I think we are now in a different cycle. What kind of cycle that is? Well, it looks like this down cycle on the Australian dollar is a continuation of this down move here. So as you can see, we got this. Let me just put this blue arrow here. We got this continuation of the down move towards the local technical support. Let me just adjust the technical supports somewhere here. This is one of them, 7,084 pips. That's a kind of an old one, and the market did not really respond to it, but still, let's still put it as a technical support for the price. It's barely support anymore, but let it stay there. 7,178. The technical resistance is at 7,224. And then, of course, at 7,279. So it looks like a pretty nice beginning for bears, of course, on the Australian dollar. And if we just put our short-term trend line, we can see breakout, test, and now we should see continuation below the low of the 7th of the January at 7,131. Any breakout below that level would open the road towards 7,084. So that's the Australian dollar. Let's take a look at the New Zealand dollar. Situation is kind of different than on the Australian dollar because we bounce, I don't know, maybe 11% here, maybe 15 or something like this. However, this is still the level of key importance, 6,857, 6,880. Those two levels are, of course, the supply zone, two technical resistance levels, and the market has been capped at this level, broke below 6,804 already. and we are approaching the lows at 6,697. The momentum is still negative. The bears are still in control of this market. So if we break below this level, please notice the fact that this looks like a downtrend right now, because we got higher highs and we got lower highs and lower lows, of course. So this is the key support, 6,753. This is the last resort, the line in sand for the bulls, 6,697. Any violation of this level is definitely going to lead us towards 6,502. Let me just extend this line here, and as you can see, we got additional line that shows us kind of a false breakout towards the technical resistance, and then back below this line. I'm talking about the orange line, of course. This one is no longer necessary for our purposes. So 6,502 pips. Here we come on the New Zealand dollar. If we speak about the New Zealand and Australian dollar, it is very wise to take a look at the crude oil, because it's a commodity, and as we know, the Australian dollar and the New Zealand dollar are commodity currencies. So right now, what is going on the crude oil? The bad news is that the 61% of the Fibonacci retracement of this wave down didn't hold the bullish pressure, and the level of 76.65 has been violated, and it's now out of the chart. We broke above the level of 79.45, and to be honest, it starts to look like 1, 2, 3, 4, 5 impulsive wave development. However, let me just check the targets for the wave C based on the trend-based Fibonacci extension. So if we just put our levels here, we can see 161 is the one I'm interested in. Now that's very big. That's one. So right now all of the important levels has been violated, and we got one of the levels here, 1.272, 79.79. Maybe that would be the target for the wave C. In that situation, wave C would be 127% of the wave A. But there is no indication of this market to stop or to terminate the up move. There is no significant response from the bulls, so please keep an eye on the crude oil, especially because we are now trading in a positive territory of the sentiment or the momentum, and we can go higher towards the highs above the $85. So short-term trend line, it will be a weak one. However, it's still kind of helpful for us. This one is no good. Maybe that one would be anything better. This short-term trend line might be used later on for the dynamic resistance, of course. But if we take a look from the bigger perspective, we could easily see crude oil is in uptrend, and all of these corrections, despite the fact that this one is kind of a big, this one is even bigger, that's the smallest one, there are still internal corrections during the uptrend. So please be careful for the alternate account of this current situation on the crude oil, from ABC corrective decline if 79.79 won't hold, to 1, 2, 3, possible 4, and possible 5 to the upside, breaking the high from the end of the October 2021. We are talking about the crude oil. Now something completely different. Let's take a look at Bitcoin. There is very interesting price action on Bitcoin, because as you can see, we just bounced from 39,540, exactly as planned, exactly as indicated in my previous analysis. This is the key zone, and we got the hammer pattern, candlestick pattern, which is maybe pretty good beginning. There you go. This is pretty good beginning for, of course, for bulls to break higher. And as far as I'm concerned, and as far as I can see from this chart, we can still, of course, test this trend line again, but we need to break above $43,053. That's the first local technical resistance, and then, of course, 45,429. That's the second one. The key technical resistance in the short term is located at 51,846 and 53,228. Without a breakout above this level, we should go way lower. Please notice extremely oversold market conditions that diverge from the price. So as you can see here and here, it's correct, but inside of this latest move down, this is a bullish divergence. It might be enough to bounce back up towards maybe even $50,000, maybe even 51,846. But whether this bounce will be enough to break higher above the blue line, well, we will see in the nearest future, because the last attempt, as you can see, stopped at the level of 50 on the RSI indicator, which of course separates negative sentiment from the positive sentiment. So this zone, 51,846, 53,228 is the key zone to the upside for bulls. That's everything for me for today. Thank you very much for watching this analysis, and I hope I see you guys next time. So take care and bye bye.